Good morning and welcome to this Monday, May 18th edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, I had a pretty crazy week last week heading into options expiration. We saw the market finish up on the week. Last week, we saw a little bit of leadership from small caps, which we've seen a little bit more often of late. This week, I think, is going to be very interesting as well. A lot of times we get carryover in the week following options expiration. So I'm not too surprised this morning to see an announcement out from Moderna, which is a biotech firm working on a vaccine for the coronavirus. Came out with positive results. The stock is up 31% in pre-market. That was the last time I looked. It's been pretty volatile, as you might imagine. But it's kind of turned everything upside down in the market. So things that weren't working here over the past month, 2 months, working really well today because all of a sudden the market's thinking, okay, well, maybe the COVID-19 virus won't be as big a deal if we get this vaccine going. And yet, on the flip side, we've got companies that have been doing extremely well with the stay-at-home orders and social distancing. Many of those companies that have been very strong are likely to be weak. And when you think about where we sit with options expiration from the end of last week, and one of the things I've been telling Earnings Beats members is many times these options expiration issues or concerns or potential reversals that we see going into options expiration, sometimes it happens early part of the next week, and that's exactly what we're seeing this morning. We've got airlines up. We've got some of the brick and mortar retailers up. I mean, talking really up. And these stocks all had max pain levels that were well above where they were trading last week. So I'm not at all surprised to see some of this action. Some of the companies that have been rolling to the upside also are down this morning. They're not participating. And so I would say that today and maybe for the next couple of days, we probably want to cool it a little bit on the strong AD chart list versus the weak AD chart list. For those of you who are not members of Earnings Beats, AD chart list refers to accumulation distribution. It's a tool that we've been using for the last couple of months to really categorize a lot of stocks into those that have been heavily accumulated over the last couple of months, many that are benefiting from the stay-at-home orders, social distancing, and so forth, really the whole pandemic. And the weak AD chart list, which are companies that have been devastated by this pandemic, showing mass distribution. I'm talking about, like the airlines, the casinos, the hotels, recreational services, that would include like cruise lines and so forth, theme parks, anything that where you have a controlled environment where a lot of people get together, anything with entertainment, concerts, stadiums, even companies like Coca-Cola that depend or have a lot of revenue that come in from stadiums for events and things. Those types of companies that have been getting hit are flipping back to the upside today. It's going to be a really interesting day to see. But the Dow Jones Industrial Average, very, very strong this morning. We are looking at a possible open of up 700 points last I looked. The diamonds were up 2.68%, Spider 2.34%. QQQ, though, only up 1.39%. Again, the NASDAQ 100 has been leading this market to the upside. These are companies that have been benefiting from the pandemic. And all of a sudden, those things are being flipped upside down to this morning. So like I said, it's going to be a very interesting day, but those who maybe have been aggressively trading the strong AD chart list and the weak AD chart list, I think you want to be a little careful today and maybe for the next couple of days, because we may see this trade, this reversal kind of trade working in the near term. All right, I want to mention a couple of things before we get into some of the charts, and I will show you. If you go over to earningsbeats.com, we got a big event coming up today. Big event. This is a public webinar, so it's available to everyone. If you go to earningsbeats.com, you can come in here, and we will be having a webinar later today at 4:30 Eastern. And it's the top 10 stocks sneak preview. And so what we're doing here is talking a little bit about our performance of our portfolios, which have been nothing short of absolutely outstanding, not just in the last quarter, but for the most part since inception. And so we're going to talk a little bit about the performance of these portfolios, talk a little bit about the strategy, how I go through this process of picking stocks. We'll go over a lot of stocks. I'll show you a lot of charts, some of the things we look for. I think it'll be very educational. And then our main event is tomorrow, which will be at 5:30 Eastern. And that will be our actual top 10 stocks that we will be putting into each of our portfolios. Every 90 days we do this. So for those who really don't want to actively trade the market, but want to participate in some of the best stocks out there, both fundamentally and technically, this is the webinar that you should be interested in. Again, performance speaks for itself, but when we get into these stocks, I mean, if you're into, buy and hold, but you've been burned because companies that look really good, all of a sudden for years and years just keep drifting lower. I mean, companies like General Electric come to mind, where you've just held and the stocks just keep going lower and lower. This isn't like that. These stocks are changed every 90 days. So it's not active trading, but you've always got relative winners. At least at the start of the quarter, you have relative winners. And the idea is that these relative winners, you're going to get a few, hopefully, in the portfolio that are going to continue to do extremely well, and they're going to carry the portfolio. And that's what they've been doing since we started this. The model portfolio was, it began back November 19th of 2018. If you think about that for a minute, that was right before the December 2018 big drop, the 20% cyclical bear market as a result of the trade war and the Fed getting it wrong and all kinds of stuff. But it was a horrible time to start these portfolios. And the model portfolio began again November 19th, 2018, had to ride out all the trade war issues in December of 2018 and throughout 2019. And then we get into 2020, we got a pandemic, first one in 100 years to this extent. And so throughout all of that, the S&P 500 has been up 6% since November 19th, 2018. Our model portfolio is up 66%, 60 percentage points higher. I think just about any portfolio manager would tell you if you could make 1 percentage point higher than the S&P 500, that product would be worth its weight in gold. But this is 60 percentage points higher. Now that model portfolio was started back in 2018 when members were asking me, we were putting together a chart list of companies that were beating earnings and revenue estimates and also look good technically, were relative strength leaders, and we put them all into this folder, but we had 200-300 stocks in there. And so members would ask, well, what are your favorite ones? I can't buy 200 or 300 stocks. I don't know how to pick them. Well, the whole idea is that all of these stocks are good stocks, but the idea was born at that point. Okay, let's create a model portfolio and let's just see how we do. And I'd say over the past 18 months, we've done pretty well. The model portfolio has beaten the S&P 500 in 5 of the 6 quarters since it began. So 18 months in, and you can see right here, model portfolio up over 66% in 18 months, and the S&P 500 gain of just 6%. So you definitely want to make that webinar on Tuesday. That's when the actual picks are made. You do have to be a member for that, but you can come in as a trial member. $7. I mean, if you go into, or if you just hit the join today button, you can go down here, read through what you get, but then sign up. You'll pay $7. You'll get 30-day trial. Within 5 to 10 business days, you'll be refunded the $7. So you have 30 days for free to try our entire service, including the picks that are made for the top 10 stock selection for all of our portfolios. So anyway, I just want to mention that. And also today's sneak preview, you don't have to be a member. If you want to just come in and check out what it's all about, just come into earningsbeats.com after the close and then click here and you'll be able to get some information. We'll make sure that you get the room instructions and everything on how to attend. All right. Let's go ahead and take a look at what's been going on in the market. So last week, Like I said, it was option expiration week. It was kind of weird because we had the NASDAQ, which really could have used a big pullback. And we saw that for a couple of days. You can actually see the NASDAQ was pulling back last week, as you might expect heading into options expiration, but then came roaring back at the end of the week. Now we've got futures up, but the NASDAQ is not doing as well this morning because, in my opinion, it behooves market makers for other areas of the market to do well. And the timing of that vaccine trial couldn't have been any better, to be quite honest. I'm beyond, looking for conspiracy theories, but the coincidence happens quite often. Let me just say that. So all of a sudden, we've got this big announcement out this morning, and many stocks that are completely underwater with tons of in-the-money put premium are rising this morning. And you might ask, well, if options expired Friday, why would it matter today? This is the next week. Well, if you understand how options work, if you've got a in-the-money, let's just talk about calls. So let's say a stock's been going up and you've got an in-the-money call. Stock's sitting at $110 and you've got a call for $100 that expired on Friday. Well, unless you sell that call, you then, if you have one option contract, you'll buy 100 shares of the stock. You exercise your option. Well, guess who's on the other side of that trade? The market makers. So if you're exercising those options in stocks that have been flying to the upside, you might have a little problem this morning. But if on the other hand, you've got these companies that maybe there were a lot of in-the-money puts, so now you've got folks that are going to be short selling when they options expire, if they exercise. Well, guess who's on the other side of that short sell? Market makers, they're buying. So would you be surprised if I told you that, let me just go over here for a second. Let's pull up Southwest Airlines. Airline stocks had a huge amount of net in-the-money put premium last week. So look at the airlines, up 7.5% this morning. Wow, that's a nice, tidy little sum. How about UAL? Well, there's 8% on UAL. Macy's has been getting destroyed. Had a ton of in-the-money puts. Now Macy's up 5% this morning. All of these things are benefiting market makers. So it's kind of a unique thing that happens once a month, right around the third Friday of every month, leading into option expiration or sometimes the following week. And that's why the market historically has gone up heading into option expiration week, but the week after, historically, it's been one of the worst weeks. Well, it is the worst week of the calendar month, and a lot of it has to do with options. So anyway, let's get back to this. Dow Jones Industrial average up 60 points last week. The S&P up 11, NASDAQ up 70. Mid caps up 11, small caps up 9. That was the highest percentage, up 1.31%. Nice rally there. As far as the sectors go, communication services, consumer discretionary, consumer staples. There's a theme there. Consumer stocks did well on Friday. And then materials and healthcare. Healthcare has been one of the best groups. You can see with the market kind of rolling over on the Dow, the S&P. Look at healthcare just kind of going sideways, holding in very well. Same goes for discretionary. Communication services actually going against the grain of the market. We're seeing the communication services moving up, very similar to what we're seeing on the NASDAQ. So I think, again, in the short term, I expect that we're going to see some of the beaten down areas outperform. So I would expect that today and maybe for the next couple of days, we're probably going to see that weak AD chart list outperform the strong AD chart list. We've seen it before. Doesn't tend to last very long. And I don't think because we have one report of a positive drug trial on a vaccine, I don't think that's the reason why the whole market's going to turn upside down for the long term. But short term, the market needed this. And so I think we're going to see it for a couple of days. Beyond that, I would have my doubts. I think we'll go back to the strong AD list outperforming, but that'll be later in the week, and we'll be talking about that more later. All right, let's move on. 10-year Treasury yield. Let me give you an update here because we're back above the 20-day. Nice move back up, 4 basis points, 0.68%. I just look at the 10-year Treasury yield here as sideways consolidating. until we get a big breakout, I mean, we've seen a little bit of movement above the 20, back below the 20, and look at the 20 itself now going sideways. So I don't think, we really know exactly where we're going with interest rates at this point. And part of that is dependent on the coronavirus and, how much of the economy begins to come back and how quickly. Because if it comes back quicker than folks realize, you're going to see that 10-year Treasury yield going higher. If it is a struggle and a lot of uncertainty persists, then you're going to see a lot of folks moving into Treasuries because they're defensive. Money rotating into Treasuries sends the yield lower. So I think right now the market's just sitting back. It's a wait and see attitude, and that's exactly what we're going to do, wait and see. Let's move on to talking technically. I wanted to mention the 10-year Treasury yield minus the 2-year Treasury yield. Now, this is the spread that I look at. I'm a former practicing CPA, and I was in public accounting for 20 years, audited banks. And so this was a pretty important ratio for banks. And I've got a 5-year chart in here. And at the top panel, this is the difference between the 10-year Treasury yield and the 2-year Treasury yield. And you can see, the direction of this net difference. Then down here, you can see the performance of banks relative to the S&P 500. And what you'll see is when this yield is, when the net difference is moving down, that impacts the net interest margin of banks, which is, kind of like gross profit of companies that sell things. Net interest margin is a big driver in banks. And when this yield is dropping, when the net difference between these two, the 10 and 2-year Treasury yield, when that's dropping, you can see banks tend to underperform. When it's rising, banks tend to outperform. Then it's dropping here. We just kind of go sideways, a little bit of down, back up. But then as we're going through all this, you can see the down, we come back up. But look at 2020. This difference has actually been moving up, yet banks have been moving lower. So I have a correlation down here that I want you to just look at. This shows the two top, the top panel, which is the 10-year and the 2-year, the difference, and then the banks versus the S&P. And what this does here is it just gives you the correlation. So if you're looking at this and you can't eyeball it, you can look down here and this will tell you whether or not these two lines are moving together or moving apart based on the last 20 periods. And I think if you look at the chart, you'll see this is +1. So this means they're moving hand in hand together. Down here is -1. So they're moving exactly opposite. And then anything in the middle is kind of, giving you an idea, a sense of are they moving together or not. Above 0 means that there's positive correlation. And the further you get toward 1 means they've got very strong positive correlation. To the downside, below 0 is negative correlation or inverse correlation. The closer you get to -1 means intense, exactly opposite correlation. And so when you look, I think it's pretty clear that for the most, majority of the time, we're in positive territory. So whatever the spread on the yields are doing, the 10-year versus the 2-year, chances are banks relative to the S&P are going to do the same thing. So if that yield's coming down, chances are banks are going to underperform. Well, you can see right now we're back in the negative territory. And back in March, we got to a -0.85. And that was the lowest in the last 5 years. Very unusual to have that kind of inverse correlation. And so, you got to think about it. Okay, so why is this happening? Why are banks, with the yield moving up 10-year versus 2-year, that should be increasing net interest margins. Why isn't that resulting in banks outperforming the S&P? Well, if you think about it, the economy that we're in right now, those companies that are highly leveraged, and have a lot of debt are generally not the companies that are benefiting from this pandemic. I mean, if you've got, a factory, you're in the industrial area where a lot of times you're heavily leveraged, those areas of the market are struggling. And many of those companies are cash strapped. And so banks are disproportionately increasing loan loss reserves because of their clientele. Those companies out there that tend to borrow are the same group for the most part, not totally, and this is my theory, but those are the companies that are most likely to be leveraged and have debt outstanding. And so as a result, banks are having to increase their loan loss reserves, which is more than offsetting the benefit that they're getting from this spread. So until the virus is contained, I actually think banks are going to do better than people think going forward. I'm not ready to jump in because I'm a momentum trader and banks are under intense selling pressure right now. I'm not trying to catch a bottom. That's not what I do. But I do think when they turn around, they could be great investments, because I think that some of this is going to turn out to be more overblown in the long term than people realize. And yes, there are some companies that are going to go bankrupt, but banks are increasing their loan reserves. They're already taking, and I can tell you that when the Fed comes in and audits banks, they don't say, oh, you know what, that's good enough. You've put some money in there. They take a very strong approach to making sure that these banks report, if something might be looking like it could be teetering, then it goes in the loan loss reserve. So my point here is that banks tend to be very conservative in their loan loss reserve estimates. So if the economy all of a sudden is better than expected, I think you will see a lot of banks' earnings going up through the roof over the next year or two, because these loan loss reserves will start to come back down again, and that will heavily impact the profitability of the banks on the good side. Right now it's on the bad side, and that's why we're seeing this relative underperformance. Anyway, just want to talk about that a little bit. What else do we have going on today? Well, talking about the sneak preview, I wanted to just give you some stocks maybe this is going to be the sneak preview of the sneak preview. So later today, I'll be talking about a lot of stocks that are on my strong earnings report, and that's where the majority of the companies on the top 10 stocks that will be announced tomorrow, almost all of them will come off of the strong earnings chart list. So I have right now about 270 stocks. I'll be sending that out to all of our Earnings Beats members, making it available for download into your stock charts account later today. But let's take a look at it. I'm just going to pull up a few of these. Look at Sienna breaking out to a new high. Look at the AD line. Throughout March, going down, AD was going up. Great looking company, being heavily accumulated. I haven't looked. Maybe it's one that's getting hit today to the downside, but it looks good. How about DocuSign? DocuSign's been one of my favorite stocks. I've been talking about it a lot. Is it going to make the cut into one of the portfolios? I don't know, but it's been on a roll to the upside. Excellent relative strength, and also accumulation distribution. How about a stock like Chewy? CHWY, another one moving up. Notice when we were going down back in March testing these lows, the AD line was moving up. So a lot of folks panicking out of Chewy, but institutions were gladly buying your shares. It was one of the really tough parts of the market back in March, but something we spotted pretty early at Earnings Beats, that everything was gapping down at the open back in March, but half the stocks were moving up after the open while the other half continued to sell off. And so Chewy was part of that group that did very well, and you can see has continued to do well. How about Chipotle? Chipotle's been in the portfolios almost every quarter since I started doing these portfolios. And the reason is this has just been one of the best stocks over the past year and a half, 2 years, last couple years. They got through all of their issues with the contamination from a couple years ago. The stock has been rolling back, and it just broke out again. Accumulation distribution strong. Let me give you two more. I'm going to give you Lilly, which is in that pharma space. Lilly's been a great performer, much better than some of its pharma competitors, Merck, Pfizer. If I was going to do a pharma, Lilly would certainly be up there on my list. Breaking out in April to new highs, continuing to bounce off that 20-day. I think technically it still looks good. And the last one, this is one that's kind of made a little bit of a turnaround, F5 Networks. Stock was getting hit pretty good in March, but the AD line moved up. We did take a little bit of a hit as we went back to this gap support area. So I think as long as gap support holds, we're okay. But that's where we had this big move down. And if you understand how AD works, the volume is a multiplier. So when you get off the chart volume, it is going to play a big role in what the AD does. And that particular day, you can see that we had the gap up, and then we came back down on a false breakout. And so that really impacted those next couple of days, really impacted the AD, but it's starting to turn back up. And I think overall, technically, it still looks very strong. So this is just a handful, a smattering, if you will, of some of the companies I'll be looking at later today, and going through some of these stocks that are definitely going to be considered for what I'm calling the draft tomorrow. And that's where I will be drafting for each of the portfolios 10 equal weighted stocks, mostly in different industry groups. I don't want to go out and put 10 software stocks in one portfolio. If software has a bad quarter, the portfolio is going to get killed. So we don't want to do that. We want to kind of pick some of the best stocks within some of the best groups, best sectors. All right, speaking of sectors, let's take a look at the relative strength of sectors. And I just want to go through this very quickly. But you can see technology, this is a relative chart. Here's the absolute chart down here. So technology got hit in February, March, just like the overall market, but on a relative basis, it held up well. It's almost like technology is the new defensive area. And when you think about it, when you think about a company like Apple, do we view Apple as something we want or something we need? Something we want would be more aggressive. Something we need is more defensive. So you need to have utilities. You need toothpaste. At least I hope you need toothpaste. Those things are things you're going to buy. Doesn't matter what the market's doing. What about the Apple iPhone? Is that something you want or is it something you need? That's, maybe 10 years ago, maybe it was something you wanted, or maybe 15 years ago. I don't know. I don't remember the timeline, but I would say today, that's something we need. I don't think people can do without. I think even in rough times, people are going to keep their phone. They're going to keep that. It's still kind of like a utility, even though it's technology, if you know what I mean. Anyway, technology doing very well. Consumer discretionary, look at the strength all of a sudden coming in at the end of March. This was a group, consumer stocks were really doing poorly. Look at what's going on over the last 6 weeks. Does that look like a bear market? It does not look like a bear market to me. Not if consumer stocks are rallying like this. Communication services being led by internet stocks breaking out. Again, another aggressive area of the market that's doing very well. Now, industrials and financials, the other side. And these are the groups I think are going to do really well today, maybe for the next couple of days, because they're so underwater from the options from last week. And because they've underperformed throughout the entire pandemic. So if all of a sudden you've got news out there that suggests that maybe the pandemic won't be as bad, then you've got these companies that have been beaten up that are going to get a lift. So look for these over the next couple of days to do well. Healthcare continues to do extremely well. So that's a group we certainly want to consider. Consumer staples, defensive. So if we're getting ready to roll over and head into this deep depression, why is Wall Street not moving into consumer staples right now? They were, but I think some of the areas leading consumer staples benefited from online or from social distancing or from washing your hands all the time or from using, hand sanitizer. Companies like that were doing very well because of the increased demand. Real estate getting crushed by this. Look for a rebound in real estate next couple of days. Utilities, same thing. Energy materials are a little different breed. I think energy still got a lot of issues, but short term, we might see a little rally. Same goes with materials. Keep an eye on the dollar to really see what's going on here. All right, earnings spotlight. I'm just going to pull up, not a lot of earnings out today, so let me just give you a couple real quick, and I'm just going to tell you what they're doing. First one up is SE, which is C Limited. Stock up 7.5%, reported earnings this morning. And the earnings came in better than expected. The loss was smaller, 32-cent loss versus a 52-cent expected loss. Ryanair, RYAAY, stock, their loss was actually bigger than expected. Stock's up 14%. But again, I think the pandemic, the fact that the COVID-19 potential vaccine out there, this is lifting airlines. We're going to get a big bump in airlines. So I think that's where we're getting a definitely rally there. What else do we have? How about international game technology? IGT, also in that area that's been beaten up pretty badly. Stock up 8.8% after they came in with worse than expected news. Actually, I'm not sure if that was worse than expected. I may have had this backwards because I thought they actually beat. I'd have to go in and double check that, but stock rebounding very nicely. You may want to check those earnings. All right, 3 you must see. Let's go ahead and pull these charts up. And I already talked about them earlier, but I think you've got to, be thinking about, let me see if this stock's getting a rebound today. No, we don't know. It's not opened yet. Well, actually, it has opened. Let's see what Cody is doing. This is another one that really could have benefited from some action back to the upside. Very, very heavily shorted company. Also, yeah, stock is up today 7%. So off of the huge selling. Last week, we didn't get much of a reversal at all in Cody, but look at the volume coming into the downside. Market makers will sometimes have buy a stock like this heading into option expiration Friday, but look at the capital that would have to be committed to try to stem the selling. That momentum to the downside was too much, even for market makers to deal with. So when you get something that's breaking down on massive volume, I think you've got to wait for a reversing candle or something. But Cody didn't show any signs of any support. So that's one that I would expect maybe will get a lift today in the next couple of days. Macy's, mentioned Macy's earlier. Let's take a look. Macy's right now up 5%. Stock reversed from down around 475, 470, something like that last week. Now at 557. So since Wednesday, it's been quite a rally in the stock. And you can see that if you look at a 10-minute 5-day chart. Look at where we were back on I think I said Wednesday. That was Thursday's low, and where we were today. That's over $1 on a $4 and change stock. So big move there on Macy's. And the last one, as I mentioned, Southwest Airlines. Look at this move. 8% today, $2. Out of the blue. Lots of reasons for market makers needing this price to go higher. And voila, get out that magic wand, because all of a sudden, airlines are up today. Not a big shocker there. Love, UAL, those stocks all getting a nice lift. And I'm sure if I pull up the airlines group as a whole, there you can see it, up 9% as a group. Look at where we were on Thursday morning at 85 on the index. Now we're at 100. Coincidence? I'll let you be the judge, and we will end the show on that. Don't forget, after the close today, make sure you go to earningsbeats.com. We will, be able to provide you information on how you can join our webinar later today. It's open to the public. We'd love to have you. Take a look at how I approach the market and how these portfolios have performed. I think you'll really enjoy seeing that. All right, let's go ahead and wrap this thing up. Everybody have a great day, and be back tomorrow over at Stock Charts TV for the next Trading Places Live. Take care, everybody. Happy trading.